Hi, this is Scott Dahl. Thank you again for tuning into one of my podcasts. What I'd like to address today is, are we in a market bubble? We've had tremendous gains in the market this year and the last few years. So is this coming to a bubble? And nobody really knows when a bubble starts, and nobody really knows we're in a bubble or have the bubble popped until it actually occurs. But I'm going to show you some technical analysis tools that I use that might determine if this market's overvalued and headed toward that bubble stage. Let's talk about some of my concerns. The first concern is that there appears to be an overvaluation in the market. And what do I mean by that? Well, if you look at the Standard & Poor's 500, the PE is almost 31 times. So what that means is you take the price of all the stocks in the Standard & Poor's 500, and you get the index number, which is currently 6080 as of today. I'm recording on December 16th of 2024. So you take the stocks, you take the value of the S&P 500, then you take the earnings of the S&P 500, all the stocks, and you take the price divided by the earnings of the 500 stocks, or 504 actually, stocks. That gives you a price to earnings ratio. So naturally, if that goes higher, that means the price is going higher versus the earnings. If it goes lower, that means the price is going lower versus the earnings. And that's how you can try to determine an overvaluation, undervaluation. So at almost 31 times earnings, are we too expensive? That's yet to be seen. And the reason I say that is because what the market is in all likelihood doing is pricing in what they believe might be a significant increase in productivity, which would mean an increase in earnings for our companies here in the United States because of this AI technology. It's yet to be seen, but that's what the market is pricing in right now. So we'll look at if this is a bubble, but the price earnings ratio, it's 31. And if you look historically, the 10-year average was 21.9%, the 5-year average in the S&P 500 P of 24.1. So we're currently 40% higher than the 10-year average of the price earnings ratio. One of two things has to happen. We have to see a sell-off, or the earnings have to come up due to this increased efficiency through AI technology. A second thing that concerns me is the fact that we're due a sell-off. We had one sell-off this year, one significant sell-off of 8%. That's very unusual. Typically, we have one sell-off of 10%. We have a couple sell-offs of 5%. So we have not had enough of a sell-off to flush this market out. So I think that there's a good probability that a correction is coming in this cyclical bull market. I will show you. I still think the bull market has a ways to run, but I think we should see significant corrections here going forward. Another thing that concerns me are analyst estimates. These analysts, they're with major brokerage houses, the UBS of the world, the Morgan Stanleys, the Wells Fargos, Bank of America, the list goes on. So 14 analysts have come out with a projection for the return in the S&P 500 for next year. The median return is 6,600. Well, right now we're at 6,080. So that's about a 10% up. Now, why does that concern me? It concerns me because they have been consistently significantly incorrect. The reason they have to put these numbers out there is because that's what their job requires. However, I know it's guesswork, and the reason it's guesswork is because nobody can predict the future. That's the advantage of technical analysis, where I'm not trying to predict what's going to happen. What I'm doing is I'm using the trend to tell me what's going to happen and where we should be positioned. So let's go back to and look at these analyst numbers. So they're saying we're going to be up 10% this year in 2025. But if you look at 2022, they were 23% too high. They predicted the market would be 23% higher at the end of 2022 than where it ended. 2023, they were 19% too low. So going into this year, 2024, it looked like to me they were hedging in the fact that they wanted to play it safe. They wanted to be conservative. So for 2024, the analysts said that the market would end at 4,650. It currently is 6,080. So they're 23% too low. So they're either way too high or way too low. So what concerns me is they're saying the market's going to be higher than next year. Now, there is one outlier, but the majority of these, 14 of them, have come out now, and they're saying we're going to be 10% higher. Based on their track record over the last few years, I'm concerned about this. Lastly, breadth. Breadth is a concern for most analysts and most technical analysts at this particular period in time, but breadth is not a short-term phenomenon. It's a longer-term phenomenon. One thing that's occurring right now is I think everybody is too short-term focused to see what the bigger picture of the longer trend is. So the breadth has been going down over the last couple of weeks. Well, that's typical because what I think short-term breadth can drop. That's the participation of stocks can go down as the trend goes down. But longer term, that's where you get your predictability out of taking a look at breadth measures. I'm going to show you that shortly. I will say this, that the first 15 days of December are typically weak, and it's more than likely tax loss selling. But then the back half of December, average is positive more often than not. The last 7 days of December go up 71% of the time on average, and it's probably going to be even higher now in probability since we've had such a strong market year. Well, let's take a look now at the breadth of the different segments. So, Mag 7, right? Those 7 tech stocks that are driving this S&P 500 higher, where they're responsible for 32% of the Standard & Poor's 500 return so far this year in 2024. And that's a concern because there's just a few stocks theoretically that are driving the whole show. Well, I'm here to show you right now that that's not the case at all. This is a chart that I have up. If you take a look at these are small company stocks. So we've got small company, mid company, large company, but you can see the small company stocks. This is a weekly chart. And this is 1, 2, 3, 4, 5 years of data. They're just now getting up and eclipsing highs that they saw back, that the small cap stocks saw back in 2021, 2022. So the trend is up and the trend is strong for small cap stocks. And when I say small cap, I mean small capitalization. So let's look at mid-sized companies. Mid-sized companies, and here's your chart again. It's weekly. We've got about 5 or 6 years of data. I'm going to shrink it right now. And you can see that we're making new all-time highs in mid-cap stocks. So it's not just these large company stocks that are driving the market higher. It's the different caps all the way down. And that's a positive for the market. Here's large company stocks. Take a look at this chart, similar to the S&P 500 because the S&P 500 is a large cap index, but you can see it's making new all-time highs as well. So we've got a very broad market. It just happens to be dropping here temporarily as we see a sell-off. Our trend is still up. I believe we're still in a cyclical bull market, and we want to be in this market until it tells us otherwise. So let's take a look at a breadth from a longer-term perspective, and this is probably the most important thing that I'm going to show you today. So what I'm doing, or what I've been continuing to do, is take a look at the dot-com bubble in 2000 and try to draw some correlation between the current days with this AI technology. But this is breadth. If you look at this chart, this is the advanced decline line. So this is breadth of the New York Stock Exchange. You can see that the breadth of the market, this is April of 1998. You can see that the breadth started to go down. And it went down for a long period of time. It went down all the way to 2000. So how does this compare to the New York Stock Exchange at that same time period? So here's the New York Stock Exchange, and you see when the breadth started to go down right here in April of 1998, you can see that the stock market continued higher. So what breadth does is breadth is a longer term phenomenon. So breadth participation, the stock's going higher, that's breadth. Breadth starts to roll over, but it starts to roll over before the stocks actually top. And the best analogy is a rocket. So the rocket goes up, it starts dropping off its boosters, but the rocket trajectory is still higher. So it's got less power that's pushing it higher, but it's still going higher. That's the index in comparison to breadth. The breadth rolls over, that's your warning sign, and the market will still go higher, can still go higher, but as breadth continues down, eventually what it does is it breaks the market. So with that, so let's go back and look at it one more time. So here's the advanced decline line. Here's the breadth. The breadth took a nosedive starting April of 1998. The market still went up for 2 years. It bubble didn't pop until 2000, but we got plenty of warning out of this breadth. So that's where we're at. We're still in a cyclical bull market, and I think there's still opportunities to make money. If you have any questions on your portfolio, let me take a look at it. Now's a critical time because it's been easy. We've only seen one real sell-off of any magnitude this year that's very abnormal. So we're probably going to have more sell-offs this year. We're probably going to have more volatility. So if we're not at a peak, what's going to get this P ratio down to more of a normalization? Well, it's going to take sell-offs. It's going to take brutal sell-offs. That way it'll flush the market. It'll get all the people that don't have the fortitude or the financial wherewithal to stay in. They get out, and then the institutions come in and start buying. That runs it up again. So if we have these sell-offs, what that can do is that can alleviate this overbought situation, because I do believe we're in a continued uptrend in this cyclical bull market. So call me if you have any questions. I'll be happy to look at your portfolio. My phone, 949-497-6366. It's dahlcapitaladvisors.com. Watch the previous podcast if you would. It goes into more detail about the analysts, and it gives you podcasts that I'd like you to go back and watch if you haven't seen them already. It gives you more of an idea of where I'm at right here is my thinking. So thanks again for tuning in. Looking forward to another one.